If you're not profitable, forget everything else, because after this video, you will be able to get setups like this. There's two types of setups, the simple one and the advanced one. So let's get into it. When we're coming from a high time frame downtrend, where we can clearly see lower highs and lower lows, the lower highs usually leave out resistances or supply zones. These zones are used by traders to enter selling positions with the goal of taking profits much lower. And this type of price action usually repeats, because that is what it holds a downtrend. It's formations of lower highs seen from the pullbacks, where usually there is another supply zone, so another opportunity for traders to enter a selling position. Now, eventually, because the market can't just go down forever, at some point the market will gain massive bullish pressure, and this will eventually stop out many sellers out from their trade with a loss. One way to stay away as much as possible from getting stopped out is by trading the first trend reversal instead of all the pullbacks, and hoping the market will continue to move down. So what we do instead, we wait for the downtrend to reverse into an uptrend. This happens when a previous high gets broken to the upside. This move forms a market structure shift. It shifts the structure of lower highs into higher highs, basically moving away from the downtrend fundamentals, where highs are protected highs, because they are not supposed to break, but then we've entered into the uptrend fundamentals of higher highs. What we would expect now is a higher low. And if we do expect that, we look to buy from that level to take the market higher. And this happens usually from a demand zone, or a support, which is found on the swing low. This is how we trade the simple approach, by waiting for a reversal. And we can look to target the next highs, or even a high time frame supply zone. And you will see many times how after filling the first form demand after the trend has reversed, that the market will print formations of higher highs and higher lows with a goal of hitting our take profit. So now when we're coming from an uptrend, we can see that because the market reversed from a downtrend into an uptrend with this trend shift. On uptrends with higher highs and higher lows, traders will look for buy setups near the higher lows, and this works one time, maybe two times, or sometimes even more. But at some point, if they keep buying each higher low, eventually the market has to come back down. This move stopping them out of their positions with a loss, while also reversing the trend once again from an uptrend into a downtrend. And on uptrends, the lows are protected strong lows, and the moment the previous protected low breaks down is when the trend reverses downwards. And now the same process repeats just like the first time. So now that we're in a downtrend, we can now look for supply zones to sell the market down into lower lows. On the euro against the dollar, being a currency, but this works just as well on any market, and we might test on other markets as well. Now what we see here is a slow uptrend formation that forms a swing high on the external price action, to later follow with a downside movement. So let's actually analyze and understand why and how this has happened. This will help in knowing what might come next, so we can take advantage by having a higher chance of finding a winning setup. So after forming the local high on the external price action, the market started entering into a downtrend on the internal price action, basically formations of lower highs and lower lows. But on the external price action, this whole downside movement is just a pullback of the high time frame, usually a move to consolidate and wait for buyers to step into the market, causing a continuation after. Then the market started showing a little bit of buying pressure, seen with a break of the past internal high. So it invalidated the downtrend fundamentals of forming lower highs, because here now we have a higher high, which was followed with a downside pullback that ends above the last low, meaning this is a higher low, so it has also invalidated the downtrend fundamental of forming a lower low, and instead here we have a recently started uptrend. Now at this moment, the market's internal price action has aligned with the external price action, both being in an uptrend. So now buying positions might make more sense than selling positions. Since we've got the internal break of the past high, that's called an internal market structure shift. This validates a demand near lows, demand that in this case did not get filled, and the market continued higher, breaking the new high, forming into another higher high. The second break of the high is now called a break of structure, and after a break of structure, we validate a new higher low, and demand zones are usually found on higher lows, meaning that we have a new potential demand zone. Here we've got an upwards push into new highs, once again, validating a break of structure and a demand. It's exactly where the price is sitting right now. So now we can plan the setup, entry on the top of the demand, stop loss below the demand, and take profit at around 1 to 2 or 1 to 3 risk-reward ratio. Or structurally, you might also look to target a break of the swing high. That's simply a 1-to-2 ratio. It's consolidating and kind of moving down for now. Bullish reaction above the internal highs, and there it is. Now on this backtest, we will try the complex and advanced way, hopefully to find a setup with upside potential. So we start by analyzing each and every single move internally or externally. For example, here we've got an upside push, followed with a downside pullback, then a continuation towards new highs, which causes a break of the past high, meaning a break of structure. So far, we got a higher high with a higher low. Then the market repeats the same type of price action once again, pulling back down after a significant break, then moving into new highs. The break of past highs is once again a new break of structure, and here once again, for a final and more aggressive move to the upside. Now, why this break of structure is so important? Because they validate a demand zone in the case where the market breaks the high. For example, here when the market pulled down, then pushed and broke the highs, we validate a demand zone. And this demand might fill or might not fill, but still is a zone of possible good entries, since we're following the basic saying of buying low and selling high. That's simply what it is. And this applies to the next structures as well. So we've got the pullback, which might fill a demand from the past price structure, and take the market higher into breaking the past highs, forming new higher highs. The formation of the break validates a new demand zone that could potentially fill on the next pullback. This is very helpful because it helps traders, and especially smart traders, giving them an opportunity for a buying setup. Now we know this is a clear uptrend, and on uptrends the highs are weak highs because they constantly break, while the lows are protected lows, or strong lows, because they are not supposed to break in an uptrend. You can see here how the market did not break below this level, then after forming a higher low, it also did not break the new low, here as well. But look at the last one, where the price has recently just moved below the last low. We zoom closer to the recent price action, and what we can see is that up until then, the market followed an uptrend that pushed into highs, pulled back down, but then it failed to break the past high, and instead it formed a lower high, while also breaking down below the last low, which was a protected strong low. So the first break of low during an uptrend is the shift into a downtrend. Now using this more advanced approach, after doing all the analysis and seeing the first trend shift, we don't actually look here for the setup, but we zoom into a lower time frame. This is the 1-hour chart, and here it's where we will keep a clean analysis once again until we find a setup opportunity. Now this being a downtrend in this time frame, on downtrends highs are not supposed to break, so it's now the highs that are called protected highs, or strong highs, which we can see on the recent ones that they did not break, holding a bearish trend. Trend that continued later by forming an upside pullback, followed with a break of the lows. And this being the first break of lows after the trend shift, it's the first break of structure on the bearish side, so it also forms a high that is lower than the past one, which on downtrends they're protected highs. And a similar price action forms right after once again, so there is the new high and new low. Now we finally got the break of the high during an uptrend, so this actually is a trend shift because as I said before, highs are not supposed to break on downtrends, so this flips the downtrend into an uptrend. And now to find a good setup, we need to zoom even closer on this entire price action area, so meaning going on a lower time frame. Now the time frame choice doesn't matter that much. The important factor is that you zoom into a lower one from here. I've chosen the 15 minutes one as an example. Now here it is, the 15-minute time frame. We've had lower lows up until this point, where the market started moving back up, forming higher highs and higher lows, but this on the internal price action. Then after a couple of minutes, the market broke down below the past low, forming the internal trend shift. This shifts the low time frame trend to move down. But the 1-hour time frame is bullish because of the market structure shift. So when this happens, the higher time frame takes priority, and we can think the internal shift as an upcoming downside move, but in the short term. Now, if we know that there are high chances that the market will fall from the current price, but we also know that in the longer time frame it should be up, that means that the market will eventually bounce up to the upside. But from where? Usually a demand zone, which is found near the swing lows. In this case, this is a demand zone. Now we can plan the setup with the entry on the top of the demand, stop loss below the demand. But might be a better idea to place it below the lows if the low is closer to the bottom of the demand, which is in this case. And now it's when all the analysis comes in being helpful on the advanced approach, because if we know that the high time frame trend has flipped, seen with the market structure shift, we can look to target a higher level for the take profit, but the exit needs logic. A first idea for an exit would be above these highs, expecting a break of structure in the 1 hour time frame, or even higher, above the protected highs, expecting them to break since we've had the trend shift. Now I would target the lower one because it's safer than the second one, while also having a very high risk-reward ratio, which is more than enough. The one from above is too greedy to target. So it bounced from the demand, with the price currently pushing above the internal highs, holding this very bullish price action to eventually close on the take profit shortly after. Now here, we see an initial uptrend formed with higher lows, higher highs, then again higher highs. But shortly after, instead of pulling back down higher than the last low, now it is broken down below the previous low, so we're basically formed a lower low during an uptrend. And the first lower low on an uptrend is the market structure shift, a first major signal that the market is reversing away from the initial trend, so from an uptrend into a downtrend. On downtrends, we trade supply zones. They're basically levels of resistance near the swing high. Because the market usually rejects back down from these zones, and based on the first approach, we can just sell short this high time frame supply zone. However, it's not the highest quality setup, it comes with a higher risk, because do you see these internal higher highs and internal higher lows? What if the low time frame trend would just continue and reverse into an uptrend? To understand that better and increase our chances to find a good setup, we usually zoom into a lower time frame and observe the price action movements right here. It can give us clues. This is on the 15 minutes time frame. We can see how the price nearly instantly rejected back down right after moving into the high time frame supply. Now this downwards push breaks down below the internal lows, validating a low time frame supply or resistance. Now this allows a setup that can give a better risk-reward ratio while also increasing the quality of the setup, having more chances of a winning setup. Sell short on the supply, stop loss above the low time frame supply. And structurally, we would place the take profit right below the recent lows. But by using this advanced approach, having done the analysis, we can target lower levels. Here is the first target, being below these lows. But as I said before, it allows a better risk reward, so we might even look for a lower level. For example, here, it is another one. And there is also another one below, being the swing low. And it's this swing low what we will target, because the high time frame supply got filled, while also filling the low time frame supply, having two very bearish signs, which coincides with the market breaking down below the first significant low, and continuing to form lower highs and lower lows, into essentially breaking the second swing low as well. And it's now getting closer to the last level that broke a couple minutes later, closing with a win. It also went even lower, but I wouldn't have targeted more than this. It's more than enough. Also notice how the market kept respecting the fundamentals of the downtrend, having protected highs that do not break, with weak lows that break into a new lower low. And this should be enough to start seeing some results. Also, by using the resources my traders have, which you can find on the link in the description, you have step-by-step explained each and every detail to sustain profitability. Because remember, being profitable is not the hard part. The hard part is actually staying profitable.